Let's do a numerical example illustrating how the residual dividend policy works. Okay, so in this case, we've got a company that has generated cash from net income of $100 million, and they have $90 million of positive NPV projects available, and they have 10 million shares outstanding. What is the dividend per share if they use the residual dividend policy? The next part says, how would it change if they had a target capital structure of 70% equity and 30% debt? And then the last one is, what if they had 150 million of NPV projects available and the same target capital structure? So let's do the first one. Let's put it down as a graph. So your income was 100 million. And this was all cash that was available. And the first thing you do with this is you will fund your positive projects. And how many projects are available? There's 90 million, which is given in the question. So the leftover amount is the dividend that you will pay. So that works out to the $10 million that the company will pay as dividends from their cash flow. So if we're going to calculate a dividend per share, it's going to be $10 million divided by the number of shares outstanding, which was also 10 million shares. Okay, so this company will pay $1 per share dividend as a residual dividend if they follow that policy. Now the second was, what if the target capital structure changes and they want to make it 70% equity and 30% debt? So what they're saying here is that the projects will be funded in that ratio. 70% by equity and 30% by debt. So if we do the projects that are available, we have 90 million, which was given in the question. And how much are we going to fund by equity? It's going to be 70%. And how much will we fund by debt? 30%. So this is, regardless of the cash you have on hand, that's the ratio they want to keep on their capital structure. So what this means is they need to fund 70% of 90 million, which is $63 million by equity. And what is equity? Equity is either your internal cash, which is net income, or you could issue shares. Remember, net income goes to your retained earnings and it becomes part of your equity. So what they are going to do is fund the $63 million with their equity from net income. And they had 100 million available. So now, the dividend paid is going to be the income minus the project equity funding. So our income available was 100 million, and we just calculated that we need 63 million to fund our projects from our equity portion. So they can now pay out $37 million as a dividend. So the dividend per share in this case will be much higher. It'll be 37 million divided by 10 million shares, which is 370 per share. Now the last part, let's scroll back up and see what they wanted. Same capital structure, but now you got 150 million of positive NPV projects. So let's just do the same thing again with 150 million. So now we have projects available that are profitable of 150 million. And we want to break down what we need to be funded by equity and what we need to be funded by debt. And really equity is what we're sort of worried about here because we're doing a dividend calculation. So 70% of 150 million is 105 million. And how are they going to fund that? They're going to fund that by 100 million of net income. But that doesn't get you all the way there. Plus, you have to issue $5 million of shares. And that'll cover the whole thing. So clearly, if you have used up all your income and are issuing shares, in this example, there's no dividend. So you can see how the dividend is going to change in various scenarios, and while it makes financial sense, shareholders aren't necessarily going to be happy with that.